welcome to Markets Weekly. I'm Karunya Rao, and today joining me is Madhuchanda. She's the head of research of MC Pro. Thank you so much, Madhu, for joining in.
Thank you.
And before we begin, I want to thank our viewers as well for waiting by. I know we've started a few minutes late, but I'm going to promise you it's going to be worth your while. Madhu is here with us. Madhu, there's a lot happening in the market. They appear to be climbing a wall of worry, going by the sharp pullback from the lows touched at the onset of the Russia-Ukraine war. In fact, Nifty 50, after correcting by more than 14% from October highs, has recovered already by 9%. And, the reaction that we're seeing in global markets is also broadly similar. Skyrocketing commodity prices ranging from crude, base metals, agri-commodities, fertilizers. At the same time, there's inflation touching dizzying highs, and with the war threatening to make it even worse. The rally in equities has been met with disbelief and discomfort, but the moot question is, are equities best avoided in 2022 till the dust settles? Madhu is here. Madhu, your report, which you released yesterday on MC Pro, says otherwise, that this is a good time to buy the volatility, and how to do that is, of course, something that you were going to tell us. But tell us a bit more about what still makes you optimistic amid all the volatility and uncertainty that's playing out.
See, volatility, uncertainty are a kind of hallmark of equity markets globally. And we have seen in the past, like what I wrote in my earlier report, which was right at the start of the war, when markets had a knee-jerk reaction, Indian equities fell by 5% on a single day, and we were near 16,200 on the Nifty level.
Yeah.
And this kind of uncertainty gives you an opportunity to buy value, and that is exactly why investors should not shun the market when there is so much uncertainty.
And it also exposes the lack of value in those weak penny stocks that
absolutely. I mean, that is something that we have always recommended, right from the time when the equity rallied post the pandemic because of the gush of global liquidity. We knew that this party is not going to last forever.
Yeah.
So while the music was still playing, it made sense to do that reallocation from weaker hands to stronger hands.
Absolutely.
But having said that, I would even say that even times like this, when there is so much of gyration, volatility, there is so much of negativity all around, fear all around, markets would tend to, give you some, a very, very interesting opportunity, and those are not to be missed.
Right, but a couple of months back, if I go by some of your observations, you had advised investors to buy the blue chips. Typically, that's what the trend is. When there is a lot of volatility, uncertainty, you go towards these high-quality blue chip names, and this strategy has worked well so far.
Absolutely.
But given the current scenario, is it a good time to perhaps relook the strategy? Is it a good time to relook your portfolio and how you've been investing so far, and perhaps make a change to the way you're doing things?
See, there has been an interesting dilemma which has come up in global markets, not only in global markets, but in the minds of the policymakers, which is even more important. You have seen a couple of days back, Fed Chair Powell, in his testimony, he is an inflation hawk, and he was sounding extremely hawkish.
Yeah.
He kind of guided to a 50 basis points kind of a rate hike in the next meeting after a very tepid start, which got the market initially very excited. But while it is very important to rein in on inflation, and the Fed chair very rightly is doing it with his very aggressive rhetoric, because that is very important to work on inflationary expectations, the markets are suggesting something totally different. If you look at the gap between the 10-year and the 2-year yield, that has narrowed drastically, which suggests that the markets are actually fearing a recession somewhere down the line, and hence this 10 rate hikes which the Fed had earlier indicated is not something that the market is going by. So the markets are really kind of confused, trying to figure out which is a bigger devil, whether it's inflation or whether it's recession. And hence, we feel that there will be wild gyrations in the market. There will be lows, which you have already seen. those lows may be retested, but there are reasons to believe that those lows should be bought.
So the spread between 10-year and 2-year, like you said, it's the US Treasury bond, it has narrowed. So at a time like this, what will be the rate hike scenario like now? Because yes, the Fed meeting happened, it was a 25 basis points hike, followed by a very hawkish commentary a few days later by Jerome Powell. So what's likely to come ahead?
So that will depend on a lot of factors. I'm sure Fed chair himself is not very clear on the number of rate hikes that is going to follow. But one thing is very clear, they are definitely going to, do a front loading of the rate hike.
Okay.
So there could be some aggression to start with, because given where the commodity prices are, given where inflationary expectations are, of course, rate hike can only do that much as far as inflation is demand driven. On the supply side shock, rate hike actually doesn't work.
Yeah.
So they are going to do some front loading of the rate hike, but the bigger concern is, the rise in commodity prices and its impact on growth. So somewhere down the line, that will also play on policymakers' minds. So we are pretty certain that the rate hike will be loads milder than what was initially expected.
I'm sure many of our viewers here are worried about their own investment journey and their investment strategy. And you just talked about commodities, which have seen an insane amount of spike in the last few months. And of course, Russia-Ukraine crisis has only made it worse. And we get a commodities update to our viewers every day, whether you talk crude, you talk cotton, you talk oil, you talk edible oil, you talk metals, everything is soaring. So how badly is it going to reflect on financials of many of these companies who are using these commodities as their main raw material?
See, that's the point. Commodity inflation of this order is disruptive.
Yeah.
We have seen, the oil shocks of 73, 78, 79, they were all disruptive. So if this is to continue for a little longer, that is definitely going to pinch corporate earnings, and there is absolutely no doubt about it. And that is the reason why investors got to be extremely choosy. See, larger companies who enjoys economies of scale, sourcing benefit, etc., they still manage it a tad better, and they have pricing power to pass it on. And the only good thing here is that unlike last 2 years when part of the economy was closed, we are opening up very fast. So the demand situation may not be as bad as it was maybe last year or the year before. So a part of the commodity price hike could be passed on, but not in entirety. So definitely margins and earnings compression for commodity users is definitely something which is a genuine concern. And unless there is a very swift reversal of the global political situation, I think this is something which is going to haunt markets for a while.
So if I'm an investor in India and I've just started my trading journey, what I've seen so far for all these years is the fact that markets were only going up in the last 2 years. But right now, if we look at the Indian markets, growth is subpar, inflation is threatening across the comfort zone, despite the government keeping a tight leash. What happens now? How do you see this impact the markets and the retail investor, the small guy who perhaps has invested his very hard-earned money or savings into the bull run which was playing out for the last 2 years?
See, one thing is very clear. Markets in 2022 are going to be a lot different from what we have seen in the past 2 years. It was like a typical bull market where everything went up. Whatever you touched turned gold. So it was like, I would say, a very easy way of making money in the markets. 2022 is not going to be that kind of an easy year for the markets. So you got to stick to quality. You got to stick to companies with a leaner balance sheet, leadership position, pricing power. Just to put it in layman's term, companies which have very little earnings risk. That should be your
Can you be more specific? Are you allowed to be more specific and tell us which baskets of the market look good?
See, there will be pockets in the market where you can still make a lot of money. I mean, I'm pretty sure of that. First thing is, you look at the financials. Not all financials are worthy of buying. But in this inflationary scenario, credit growth itself will get a leg up because of inflation. companies will have to borrow more because their inventory cost will go up. So that itself will, you know, and coupled with that, we have a whole recovery taking shape. So yeah, banks' credit growth will be loads better. There are banks where, you know, where the balance sheet is squeaky clean. They have provided, they have more than provided. They're sitting on very healthy provision. And many of the NBFCs, etc., the shadow lenders have been rendered extremely weak. And those stocks have corrected. So one should look at those kind of stocks which have corrected and there is very little earnings risk. I just gave financials as an example. There could be consumer companies, there could be automobile companies. Of course, there is gross margin pressure, there is EBITDA pressure, there is, you know, this whole issue of semiconductor shortage. All that is being plaguing the sector. But you are getting it at a value which is much lower than the average of the last 5 years.
You know, on that thought, you're not the first one telling us that, you know, a lot of these stocks are available at very low, attractive, reasonable prices. I have a question about how low will this go, the market overall from here on? How low is, you know, or how much more of volatility or worsening of the sentiment can we see? And at what point, you know, should an investor look at dipping in? Because there can never be, you know, a correct time, or, you know, you can never time it.
There is nothing, see, the worst thing to do is to try to think that you are so smart that you can time the market perfectly. That's a very foolish strategy. But just to allay the fears of investors, we have done some research, and I would just like to highlight a part of that finding. We looked at the markets, the market that we looked at, of course, was Dow Jones, because we don't have such long history of any other benchmark besides Dow. So we looked at the Dow's behavior through all the previous crises, which is the oil shocks and the previous recessions post 1945. Of course, the oil shock led to significant correction of Dow during that period. So what is the conclusion from there? There is a possibility, should this reversal not happen in a hurry, there is a possibility of market retesting the lows. But don't fret, don't panic about it, because our findings also suggest that in the past we have tabulated about a dozen past US recession. Well, the markets might have gone up or down during the recession, but 6 months following the recession, in each and every case, the markets have given a positive return, which indicates that the lows should be bought.
You know, one thing is for sure, 2022 definitely does not look like an easy year for retail investors. Madhu, what should be the retail strategy now for budding investors?
So what we feel about this market, on one hand, there are worries about, you know, the global inflationary scenario, Indian inflationary scenario, that could get worse actually, because so far we have not seen a revision in fuel prices to that extent. We have seen just token revision. Last 2 revisions would be token, because at $120, our calculation suggests that, you know, petrol prices should have been hiked by 24 rupees. And we have hardly seen any revision. So a lot is riding on whether the government will be in a position to reduce the fuel taxes to ease the burden on the consumer, and that too is riding a lot on the LIC IPO. How that happens. So everything is like linked in a cobweb. But having said that, markets has its own mind. Markets knows that maybe 23 will be a little bit of a subdued year, at least the first half. But yeah, Indian earnings journey is a long journey, and it's going to be a rewarding journey. And so investors got to participate and not panic about these gyrations. Having said that, our outlook for 2022 is we believe that markets are going to be in a tight range of 10 to 15%. It's not going to be a one-way street, as you rightly pointed out. And the average could be, according to us, given the forward multiples that Nifty has so far traded and the earnings outlook, putting all that piece together, we feel that it would be, the average would be something in the range of 17,500 to 600 with the plus and minus of 15%. So 16,000 to 16,500 are the kind of lows that you should start investing in. And you should also shave off some of the gains when you get that 18,500, etc.
Okay.
Because, you know, it's not going to be a one-way street for sure.
Absolutely, absolutely. Well, I hope our viewers are taking note of that. And if you have any questions for Madhuchanda, please bounce them off right now on our YouTube Live. We're taking questions, but before we address some of our, viewer questions, Madhu, you were just mentioning about LIC IPO, and a few others have also postponed their public offers because of the weak market sentiment. There's a lot to learn from these IPOs that, launched last year with a lot of pomp and show and fanfare, and
the
now
mood was very different.
Yeah, I mean, look at what happened to a Zomato, a Nykaa, even a solid player like Nykaa, which is a profitable company, also came down, took quite a beating. So what do you think are the big lessons here to learn for investors who just want to, they just invest for the sake of not having a FOMO?
See, market mood has changed. Last year, the market was all about momentum.
Yeah.
So you were chasing the momentum. So there was a FOMO, as you said, fear of missing out.
Yeah.
If I don't get Nykaa, we know the famous cases of missing out on Nykaa, right? Nykaa is an absolutely sensible business, and we feel that Nykaa will have its day in the sun again. But at this point in time, anything to do with, back-ended earnings, anything to do with a relatively fancy valuation, Nykaa, of course, at the time of IPO was valued much at a premium than any retail player that we had seen in those times. So obviously, those are getting punished. This is a market to look for value. So I don't think the bucket that you're talking about here fits into the proposition of, great value. But having said that, yes, some of these players will definitely survive and do well, do better, focus more on profitability, as Nykaa has already stated very clearly in its last earnings call, that they are going to focus both on growth as well as profitability. Profitability is not something that they are not concerned about, they're extremely concerned about. So I'm sure that, you will get some of these so-called fancy businesses at not so fancy valuation now, and it merits looking at some of these non-fancy valuations.
Right. But while on one hand you have a solid company with good fundamentals and outlook like a Nykaa, then on the other end of the spectrum you have a Paytm. I'm sure many of you, many of those who received the IPO shares are now
wondering at what price they got it.
Exactly. I mean, it was listed at what, 1,200 rupees?
No, it was listed at 1955.
Yes, 1955. So, and from there, look at what happened. And
555.
analysts like Macquarie are still dumping it and are still, dissing it. What is the future of a Paytm?
See, I think for us to comment on the future of Paytm would be amateurish, but I can tell you what should be the strategy with Paytm.
Sure.
So there are two kinds of strategies with Paytm. One is a purely tactical call. Look at this company. When it got listed, the market capitalization was 1,39,000 crore. That was the IPO valuation. Today, is this down to 36,000 crore, right? So should this markets go up? So tomorrow, suppose there is a truce in this Russia-Ukraine conflict, commodity retraces, you will see a rally in equities.
Yeah.
We don't know the end game of this war, but if there is a sight of the end game of this war and commodities do correct, you will see a rally in equities, and Paytm certainly having been oversold, absolutely, we'll see that kind of a tactical uptick from this level.
Yeah.
So if you are playing the stock as a risk taker, purely tactically, from a price perspective, definitely there is a play. But if you ask me, do you like Paytm as a business? We don't. And we have never recommended Paytm even at the time of the IPO, because, at the end of the day, it's a payment solution player, which is a crowded marketplace. There are regulatory risks. They are talking about so many things. They are talking about being a financial service player. They have a motley of offerings. They have everything, but nothing scaled up so far. They are comparing themselves with Bajaj Finance, a company with 4,25,000 crore market cap. It's a formidable lender where technology is going to be the icing on the cake.
Yes.
And here we are talking about an aspirational guy who wants to be a Bajaj Finance. So if you ask me, is it a stock for the risk averse? No. But is it a stock for tactical play? the answer is yes.
Wow, I'm sure our viewers would have benefited a lot because we've been getting a lot of questions on Paytm over the last few days. One interesting aspect which we're yet to cover is investing abroad amid, volatile times. And just this morning, we had done an explainer also on Money Control about what are the avenues for investing, say, in a stock market in the US. One of our viewers is also asking the same question. Should I invest in US stocks at this juncture? Would you recommend that?
See, selectively, I mean, I'm not going to be talking about a specific company because we don't have those companies under our coverage. So I think we should not be commenting. But as a diversification strategy, investing in the US also means that you're getting the benefit of the currency. So, albeit everything, US is the most innovative country. Yeah. They have the most innovative corporations listed there. You cannot compare the capability to innovate and change, which you see in the big tech, that you will not find anywhere else in the world. So definitely, US markets are also correcting. They are also giving up a lot of froth, which was there. Definitely, it makes sense to diversify to other assets classes, especially US assets.
A couple of questions coming in on Ruchi Soya. I mean, I'm not sure if it's under our coverage or not.
Not really. We don't cover, so we would refrain from commenting on something we don't cover.
I thought as much. But overall, Madhu, what are the packs you're liking right now? Banking has done well. It corrected a fair bit, but it has also seen good recovery from those levels.
I think there is a lot of value. So look for value across sectors. But couple of sectors that I would like to highlight. One is export-oriented sectors. See, even if there is, there is a rate hike in the US, or whatever correction happens, because correction is already happening, because of commodities. The weakness of the rupee is here to stay. It is not going to reverse in a hurry.
Yeah.
Although RBI is intervening, rupee has not really, nosedived. But definitely, the weakness of rupee is here to stay. Thanks. We have already done exceptionally well in terms of exports, and that's something the target is going to get upped for the next few years. So I think a mild to moderate depreciation of the rupee is good for the country.
Yeah.
So the entire export pack looks very interesting to us. Especially, I would like to start the discussion with technology, because technology is not a cyclical play anymore. If you look at what Accenture said after its earnings call, which was right after the war started, they have said very clearly that whatever happens, whether it's commodity inflation, whether it's a great resignation, or whether it's a changeover to cleaner technology, companies are going to spend on reducing cost.
Yeah.
And upping the game with the help of technology. Yeah. So that's a very secular proposition. So they don't see any risk to earnings because of whatever is happening around the world. And on the top of that, you have the currency, which is like the icing on the cake.
Yeah.
So definitely that's a sector to look at. Even our own exports data suggests that there is a lot of diversion which is happening to India in terms of specialty chemicals, etc., because of this China plus strategy. And going forward, especially from the Western countries, you will see a lot of sourcing diversification because of the geopolitical conflict. You cannot afford to rely on a particular country, whether it's your friend or foe. Because of the geopolitical tension.
So export plays are looking
good. Plays, especially where there is an imports, where there is a substitution from a large player like, say, China, whether it's in, whether it's in API, whether it's in specialty chemicals or something else. Those are interesting pockets. Another pocket which I would like to highlight, especially post the pandemic, and we have written a lot, we have recommended a lot of stocks in that space, is where there is a shift from the unorganized to the organized sector, because the pandemic has been very, very harsh on the unorganized sector. So be it a luggage company where there's a large unorganized sector, or be it even today we have released a note on Relaxo, where there is a shift from unorganized to organized taking place, or say Value Innovare, where there is a very large, so there are plenty of those examples. All jewelry. That's why Titan is where it is today. So I think that's also an important play, and PLI remains our favorite. So I think anything to do with Make in India, be it in defense, we have suggested quite a few defense stocks in the last few days, and if this geopolitical tension were to continue, and it definitely will mark a shift in geopolitics, no gainsaying that. So defense stocks will continue to remain in focus. One, because they are going to be import substitution plays, because India is going to, India will have to reduce the import content in defense, and the defense budget, you can't just afford to reduce it at this point in time. So I think, there are, even in any bad market, you will have plenty of investment options, but do follow the discipline. Don't get panicked when the market hits the lows. Those are the times to buy. And don't be too greedy when the market reaches the high.
Absolutely. Well, lots of food for thought for the weekend, and I'm sure you all are going out of this chat taking in a lot of insights that Madhu had to share with us. Lots of stocks, lots of sectoral views, the macro view on what's happening not just in India but in the US market as well. So I hope you enjoyed it. I had a great time chatting with Madhu as always. Thank you so much for joining in.
Thank you.
And thanks to our viewers for joining in and also waiting by patiently earlier on in the show. Thank you once again.